Once again, my name is MJ Shao, and I'm excited to kick off our content here on traditional project finance vehicles. First of all, it's great to see so many familiar and new faces in the audience, so we have a lot of good content here. Before we get started with that, how this is going to work is each of our experts here are going to give about a 15-minute presentation. And then at the end, we'll hold off with questions and answers until the very end, in which we'll be able to sit down with all three of them and also get some of the questions from the audience. So getting right to it, let me first introduce Brett Pryor. He's with Global Business Development at SunEdison. Before, he was a senior analyst at Photon Consulting and a great company called GTM Research. And before that, with equity research with mutual fund managers in New York and Honolulu. And he's going to present on unleashing the supply of tax equity. So, Brett.
Thank you. Great. Well, hello, everyone. As MJ mentioned, I'm Brett Pryor. I'm with SunEdison. Been there about a year now. I actually do not procure tax equity for SunEdison. I'll give that one caveat before I dive in. But it is an area, obviously, that we spend a lot of time on at a company. And my role is actually more directly focused on project acquisition, both development stage and operating projects for SunEd, as well as helping out with innovative new financing vehicles like the YieldCo. So before we actually start on the presentation, I did want to ask a question to get a sense of who's in the audience. So maybe if I could just have a show of hands for folks that work at a company where in order to enable your own projects, you need or your company needs to raise or procure tax equity. So that'd be a developer. Okay, so a good number of folks at call it the mercy of the tax equity investors. How about second, folks who help in one way or another as sort of intermediaries, so consultants, advisors, lawyers who might be involved in tax equity transactions. Anyone in that camp? Okay, great. And then anyone who actually is a provider of tax equity, so a firm that we'll take that for a zero. And then last, anyone here who doesn't really care about tax equity or is maybe hoping to figure out what it even means by this talk. There we go. Okay, so I will caveat this again by saying I'm not going to explain what tax equity is. And so for folks who are like really kind of not focused on this part of the industry, this might be a little less obvious as to where I'm going, but I'll try and cover it in a way that is accessible to the layman. So tax equity, the headline here is actually a title of a Zeppelin song. This song remains the same, but not for much longer. So generally, when you're trying to get a solar project built, you can or cannot have debt, but you're always going to need equity. Just sort of definitionally, someone's going to own the project. And that could be just straight sort of cash sponsor equity, or in some cases, you'll bring in an outside party that provides investment generally in return for the tax benefits, so the ITC, depreciation, et cetera. So in many countries, this term doesn't exist, and they kind of scratch their head when you even mention tax equity. So basically everywhere where solar was giant for a number of years, where they had feed-in tariffs, this was a non-existent term. But in the US, for a number of reasons, we do not generally have feed-in tariffs. We have a large ITC, and we have favorable depreciation treatment. Those two things mean that you either, as the owner, need to have profits that you want to shield to put those to work, or you need to find someone who does, right? And so that generally is a very profitable company that is comfortable with complex financial structures. So in general, moving on to point two, tax equity remains a headache. I think at almost any of these big conferences, you'll hear people kind of gripe that this is a bottleneck, that it's been a challenge to kind of reduce the cost of tax equity. It's been difficult to get new players to enter and provide tax equity. And so that is not gone away. It involves more complex structures, so those are the lease pass-throughs, the partnership flips, the inverted leases that you hear about that, are terrific for the industry that, provide services, because these are very complicated structures and you need specialized accounting and law firms to help, but they are a drag for a lot of other folks. The second point, tax equity remains dominated by a lot of the same names. So, on some of the following slides, we'll show, who's been investing, maybe who's missing and might enter. But generally, it's banks, insurance, and maybe Google, which doesn't really fit cleanly in the other categories. And then, we're not going to go into a lot of detail. This is meant to focus on DG, but it's worth mentioning that there's actually a lot more capital going into utility projects, not surprisingly. And that model's actually quite different. There you have a lot of the utilities and the IPPs actually putting in giant dollar amounts. And these are the deals that you hear about, sometimes the loan guarantee projects, where you see names like Exelon, MidAmerican, Southern, NRG, NextEra, often putting billions of dollars into individual projects. Very different structure than what you're seeing on the DG side, and it's a slightly different model. And then finally, I think the emergence of yieldcos are very likely to change the landscape a little bit here. Worth mentioning that people for a while have realized one of the problems in the US is that we have a capital stack. The debt is relatively affordable, cash equity is a little expensive but not bad, and the tax equity is kind of expensive and there's an imbalance. So people have been digging around trying to find a silver bullet to solve this, and the first one that folks came up with was securitization. But securitization solves the problem of debt, but debt already wasn't that expensive, so that hasn't really solved the problem. And now people are very excited about yieldcos, also going to be helpful, also important, but yieldcos don't have profits to shield, so they also don't solve the tax equity problem. So while I think yieldcos will roll up more projects and be able to have basically leverage in raising tax equity, it is not a change of sort of the way things will be financed. You'll still need tax equity, at least until the ITC runs out or until, the investors get comfortable just having the solar projects use the ITC directly. So for folks who are subscribers to GTM, I think this chart may be familiar. I can't take credit for it. I think this came slightly after my time. But at a high level, what you'll see across the top are some of the leading players. I think SunEdison is not on there. We'll have to remedy that at some point. But I think generally these are folks that have made public announcements about who they've partnered with. And then going down on the side, you'll see kind of the main providers, the banks that we've talked about. You'll see a couple non-banks such as PG&E on there. Google obviously stands out, and then one or two other unusual players, Honda and WGL, which is actually Washington Gas. And then what I've done, just to kind of make things a little more obvious, you kind of see along the side there, the numbers indicate how many funds they've been involved with. So for example, US Bancorp is at the top with 5, and then across the bottom are the number of funds that each of these sort of third-party owners have raised. So SolarCity's well in the lead with 9. Again, it's just a rough number, 25 total announcements. And I think, you see there's a good variety of both, size as well as focus. So some of these firms worth mentioning, SolarCity, SunPower, they also focus on the commercial side. So this is not just a residential look. Looking at that chart, if the question is, well, how are we going to unleash more tax equity? I think the question becomes, well, who's missing from that table? Why aren't there more players getting involved, providing funding to those names and others in the space? So I think some of these names actually are involved. For some reasons, companies don't always want to disclose funds that they're involved with. So they might be actively providing tax equity to the space, but they haven't necessarily issued a splashy press release. But I think a good example, Bank of America is providing quite a bit of debt for projects. It's possible they're also providing some tax equity. Wells, I think, is definitely providing tax equity and maybe just not on that previous chart. And then I've listed a number of other more kind of regional banks or international banks that own U.S. chains that have been active in the past or may become active again in the future. Another set of companies that I think are on the hit list of a lot of these folks who are raising tax equity are the big, profitable Fortune 500 companies, and especially the tech companies. These are companies that generally have a mandate to kind of find a way to offset their large power usage, and whether that's directly procuring solar or maybe along the lines of what Google's doing, finding ways to offset by investing in solar. These are some of the names that kind of come to mind as potential providers of tax equity, even if they're not involved yet. And then worth mentioning on the previous slide, Energy Capital Partners, kind of in the bottom third there, they're actually more of an infrastructure private equity firm. And so that's another category that might consider this space. Worth caveating that they're generally looking for relatively high returns. So if they're going to get 8 to 10% unlevered, that may or may not be enough to excite them, but another potential category as well. I'm not going to go through all the numbers on this slide. I think this is another great sort of roll-up of who's leading in terms of actual dollar amounts raised. So not surprising, SolarCity, Sunrun, Vivint, SunPower towards the front of the pack in terms of total dollars raised. I think these numbers are large, but I wanted to put these in context. So the next couple of slides will show how this breaks out by segment and where some of the leaders are. So these are kind of my own estimates that I put together. Slightly rough, they're sort of ballpark just to give color. But I think, if you look at the green bars for tax equity, you can see while residential and non-residential are large in 2013, they're still dwarfed by the utility space. And so in terms of focus, I think one of the challenges, if you're trying to get someone who is a tax equity investor to look at, say, a $50 million fund, it's hard for them to commit relative to the opportunities on the utility side. So I think one of the things that's likely to change is that over time, the res and non-resi market are going to grow likely faster than the utility market. And so the total dollars needed for tax equity will be larger, and it will become more worthwhile for those providers to focus more of their energy on the DG side of the business. So actually kind of diving a little deeper into the individual kind of tax equity players who provide these, I basically take these same numbers, but just the green bars, and then add the breakout for who's the company's providing. Again, these are rough estimates. These are not provided by the companies. These are my own sort of black box version of what we think is happening. And I think you'll see, again, U.S. Bancorp, Credit Suisse, these are likely two of the larger ones. There's a number of other players right in that same size. Usually it's going to be companies that are providing quite a bit in the commercial space, just because that's slightly larger, and firms that have multiple funds. Worth mentioning that on the utility side, you actually see quite a different story. These aren't pure tax equity players. These are often utilities, IPPs that are putting massive amounts of dollars to work in mega projects. So things like Mid-American, NRG, NextEra, Southern, worth kind of calling out as some of the largest providers on the utility side. So that was basically what I wanted to cover. Just some high-level thoughts on where the industry is, where it could potentially be going. I wanted to keep this relatively short, so I think I'll wrap up with that, and then MJ, let you take it from here.
All right, thanks a lot, Brett. And once again, we'll save questions for the end of the three presentations. So next up, we have Michael Midden. He is the Senior Director of Sol Systems. And before that, he was the co-head of energy for Dexia, leading their renewable energy effort for their structured financing lending group in North America. And Mike today is going to talk about driving down interest rates in debt. So Mike?
Good afternoon, everybody. I want to talk about the debt markets, try to give you a little bit of an overview of the debt markets. I got one slide that's kind of a history lesson as to how we got where we are today. So if you'll just bear with me through that slide, it kind of sets up the rest of the information that I have. And what I want to do is I want to talk about who are the debt providers for solar, utility scale, and also DG in general, and then drill down a little bit to their pricing and tenor, and then talk about liquidity. So those are the three views that I'm going to try to give you this afternoon. Brett did a great job, especially describing the insurance companies and the commercial banks that are involved in the space. So I have that on my slides, but Brett did a great job of setting that up. One thing I just wanted to spend just a second to talk about Sol Systems. Sol Systems is a name. It's kind of a strange name. You're not sure what it is. So I do want to let you know that we are a financial service company located in Washington, D.C. We provide, the company actually started as an SREC provider, SREC aggregator and broker for the industry, and grew out into the various parts of the capital stack. So we have our deepest experience in SREC aggregation, with over 200 million sold or brokered, and we also provide debt. We closed a $100 million debt fund this year to be focused on the commercial and industrial space in solar in the United States. We provide project level debt, back lever debt, also tax equity. One of the unique things Sol Systems has done is they have actually brought new players to the C&I space. And they've done that through just really knocking on doors, going out, meeting people, kind of walking them through what the needs are for tax equity and walking them through their first transactions. And also we do full takeout. So those are the services that we provide. We have about 25, 26 people in DC right now. We are not a developer, and we do not put our own money into projects. We provide financial services for solar projects. Developers and investors in the space. Now, here's the history lesson. How did we get where we are now? Right now, the U.S. debt markets are in a tremendous amount of flux, like a lot of markets in the United States. And there's a lot of change going on. There's players are changing. There's new leaders. Structures are changing. Business models are changing all across the board. How did we get here? There were two basic trends that emerged in the last, almost 8 years now. And that was first the financial crisis. The first trend that emerged was in the financial sector itself. We all know about what happened with the financial crisis, but the results of the financial crisis have left us with less liquidity in the market. And one of the reasons for that is that there's higher regulations in the market. And that has occurred through a regulatory regime that you may have heard of called Basel III. And it has forced commercial banks and regulated commercial lenders to bolster their balance sheets. That means they're providing less money into the markets, and that they are also being restricted on tenor. So those are the two things that we don't want. But that's what's actually happened, and it's created an actual hole in the financial markets, and that hole has been filled and is being filled with other players, and that's a little bit what I'm going to talk about. So the other trend that occurred was actually in the energy markets in the United States, where we have less central station financing going on. The regulated financial institutions for decades were focused on large central station financing like coal-fired, gas-fired, and also renewable energy financings in the hundreds of megawatts for one transaction. And what has occurred is that as energy demand has waned in the United States due to energy efficiency and also renewable energy, there's been less central station financing opportunities for these institutions. So you have these two trends occurring at the same time, and this has roiled these markets. And new business models the existing players have had to look at their business models and refocus and find out new places to finance and place money in the markets. And we heard a little bit about that through Brett's presentation on residential financing and what the current players are doing. But now also at the same time, there's been a rise of new players in the market in the distributed generation sector. And in 2008, there was this prediction that occurred that there would be new pools of financing that would emerge from the financial crisis during the depths of the crisis and when there was no liquidity in the market. And we have certainly seen that play out. And we have certainly, it took a while, it took a few years, but we've certainly seen that play out in the last, I'd say 4 years. You've really been able to see new financial players, new business models, new companies like Sol Systems emerge to try to fill this gap that's been created. So there's been a rise of new leaders that most of us know about. For example, Google, Hannon Armstrong, Seminole Financial, Yieldco's, Solar City. We know these. I don't pick these names because these are our business partners, but just to let you know, that's kind of who I'm talking about. There's just been a great rise in these markets. So I picked these different categories to kind of organize the information. These are broad categories. I did include international commercial banks, and insurance companies on here, even though our focus here really is distributed generation, and to try to give you a continuum and a sense of what the full financial supermarket looks like. On the left are financial companies. And this is the broadest sector, so if you want to ding me on my presentation about clarity, this is the category that's really pretty wide and it includes a lot of different types of business models in it, so it's a little bit hard to categorize. But this sector here of financial companies, this is the new pools of capital that have really emerged to try to fill this gap in funding, and particularly in the DG sector. So who am I talking about? I'm talking about different players like Seminole, Mosaic, Derlang Lawden, DDL, Sol Systems, and then certainly on the pre-construction side, so this is financing for projects before they're ready for project financing or construction debt. There's been an emergence of sub-debt, mezz debt, quasi-equity in the market, and you can find that through True Green Capital and Ares, for example, among others. There's a lot of others that are out there, but these companies have provided new liquidity for build-out in the DG sector, and this is pretty exciting and pretty interesting part of the sector to watch. On local banks, just in the second, who am I talking about? Some of them have already been mentioned by Brett, and that's IPIC, Alliance, East West, NCB, Fifth Third, and Admirals banks are some of the banks that are providing debt directly to projects in the distributed generation sector. And then we go to the international banks and the insurance companies. In the international banks, we're talking about Santander, BBVA, the Japanese banks, the German Landesbanks, for example, and the other banks that Brett mentioned. Insurance companies, MetLife, New York Life, Manulife, Prudential, and Allstate. So just starting on the left-hand side for financial companies, this is the widest category. These companies, what can they give you? They can give you flexibility. It's a broad category, but they can customize, they can negotiate different, to your needs, to whatever you need on a particular project. They come in a whole variety of structures. It can be traditional project-level debt that is very reasonably priced and competitive with local and regional banks, or it can be early notice to proceed financing, which is going to be a lot more expensive, and you're in your teens. As far as interest rates are concerned, you're in your teens. You're probably in 13, 14, 15% if you were looking for some kind of equity, quasi-equity, sub-debt, or mezzanine debt in the market. The tenors here vary quite a bit. Some of these providers can go as long as 18 years in their financing, but some are really interested in just a few months or less than a year, and they want to invest and they want to get out. This can be expensive, as I said, but some of it can be very competitive. On the local bank side, debt sizing can be very attractive here. This is just one of the, I think, one of the untold stories in what's happened in the last few years is the emergence of local banks in DG and renewable energy financing. It's not terribly deep, it's not liquid, it's not so liquid, but they have been providing a certain part of financing in the market for people that have established local relationships. Also local investors, local high net worth individuals we see providing money into this sector and on a debt basis, on a tax equity basis, et cetera. One of the things that you'll run into that you could run into with local banks is that the tenors can possibly be shorter. These are regulated institutions, so they do face some of the same regulations as far as tenor is concerned, so that can be a downside. And also, you can run into a maximum investment limit per project. So if you're the right size for a local bank, that's great. If you've got a portfolio that's greater in size than for that local bank, you're going to have to diversify your investors in your project. You're going to have to look for other diversified investors, just so you have a cadre of different possible people to go to. The international commercial banks, they provide very attractive rates, some of the lowest in the business. They're focused on risk, though, so this can take time to work through financing, so you got to make sure that everything on your project is really buttoned down, and if it's not, it will be by these international commercial banks, these large commercial banks looking at it. The tenor limits, because of the regulations I was talking about, is really now down to 5 to 10 years. This sector used to provide debt financing of up to 18 years, sometimes even more. But because of international and federal regulations, they're now restricted. And you can find exceptions, but generally it's 5 to 10 years. It'll amortize maybe over 18 years, your debt. So what does that mean? That means you have a balloon payment at the end of year 7 or at the end of year 10, and that means you have new refinancing risk. You have a new risk, and that's refinancing risk on your project. So something you have to think about. So it gets a little bit complicated. The other issue they get into with the commercial banks is that they have a minimum size, and that's been preventing them from really entering into the DG space. So the international commercial banks really aren't very active, and we see so much in the DG space. A little bit, but not so much. And I'll just leave insurance companies because they're not so active right now, and I just put them on there for a spectrum. But I will say that these players for securitization, private placements, and also green bonds are expected to be very active players and provide a lot of liquidity in the market that MJ was talking about in the future, especially for residential. I'm going to move on now to pricing. There's a lot of information on this slide. One of the main points that I want to make with this slide is you see the 2 blue boxes at the top, they're about tenor. The 2 boxes at the bottom are about pricing. The 2 general trends that you see here are that, why I put it on the slide, is that tenors are very important. I often, many of us often get in conversations in this business about, well, somebody told me just yesterday that they can provide me with debt financing for 5.5% all in, or 5.25% all in. But the second question is, well, how long is that debt? If you want long debt, just generally speaking, so if you want to go 15 years, if you want 18 years financing to improve your IRRs, it comes with a premium, generally speaking. It's not because I say so, it's just generally that's the way the markets work. So you have to be very careful about what your pricing really, what the tenor is associated with your pricing. So just on financial companies, I apologize, this is the widest sector on this sheet, but tenors can go, like I said, for somebody who just wants to provide short-term mezzanine financing or sub-debt financing, 1 to 2 years. It can go longer than that, but project-level debt in this sector can go certainly up to 20 years. On local regional banks, you can see financing in the 5 to 7 year range, like we talked about, because for restrictions. The same with the commercial banks. But the real gold standard is really with, the holy grail is to work with insurance companies. They want to place money, they want to place long-term debt, they'll go 20 years on a 20-year PPA, sometimes, or 19 years on a 19-year PPA. That's pretty long. And that's some of the longest you'll get in the business. So they're great to work with if you can achieve that, particularly in residential. The other general trend on the pricing at the bottom is just, I'd say, a lot of this pricing is outside of the first one is generally similar. And the real comparison comes as Brett was talking about with tax equity. When you have tax equity that requires between 9 and 11% IRR compared to this, this is just cheap money across the board. And then the last view I wanted to give you is on liquidity. So where is the money and how deep is it? Hard to measure, quite frankly, but in residential, I think it's been established already that it's pretty deep, and it's going to get deeper. So there's adequate liquidity in that. The second category of less than 1 megawatt, this is the category that we see as being the most acute as far as liquidity is concerned. So these are single projects, single assets that are looking for financing. It's very hard to get, just because of the size of the project and the due diligence involved, it's very hard to get any of the other players outside of local banks or local investors involved except for takeout financing. Takeout financing is very active in this sector, probably provides some of the best financing and liquidity. In the 2 to 7 megawatt sector, you're finding the financial companies or the new pools of capital that we talked about that are very active in this sector, and also local banks. This is where you find the new entrants, and also takeout financing is very active in this sector. And then as you grow with 8 megawatts or more, it could be 7, it could be 5, around there. Obviously, you're going to find a lot more interest in the market. But it's really the point of this slide is I think the less than 1 megawatt single asset projects are really kind of the toughest to find financing right now. So that was it. That gives you a shot of just the debt markets and where they play right now. Thank you.
All right, great. And we will wrap up the presentations with Ed Fio, who is the CEO of Coronal Management. Before Coronal Management, he was a co-founder of USRG Renewable Finance and was instrumental in arranging senior debt on over 375 megawatts of rooftop solar. So we're very happy to have him talk about project mergers and acquisition trends and valuations within that space. So Ed?
What's the trick here? Great, good afternoon. And I apologize in advance. I'm recovering from I'm on the tail end of a cold, which got visited upon me by my 3-year-old granddaughter a week ago. It's always fun to get together, and then, you get new microbes in the house. I'm going to talk a little bit about Project M&A. I'll give you the 30-second spiel on Coronal. We're actually renaming ourselves Coronal Group because we're doing some different things now. We're a fund management company. We're affiliated with Panasonic. It's actually what's called Panasonic Eco Solutions, which is a B2B business within Panasonic North America, providing installation and management services around solar, HVAC, energy storage, and energy management. Our role is to, with Panasonic, we provide development financing, 100% construction financing, and long-term debt and equity for projects in the DG and small utility space. So in my 15 minutes of fame here, I'm going to talk about what are the trending valuation drivers for projects in the space, who are the buyers, and where's pricing going. So I'm going to guess in this room, everybody's made their way through models trying to figure out, how these projects are valued. I mean, there's a number of factors, and I threw some down here. Where's the project in the state of development? If it's a pre-NTP, what do you think the cost of install is going to be? On the revenue side, what's the production of the system? What do you get paid for the power? Is it contracted? Is it not contracted? What's the credit of the offtake? All affects value. What are the operating costs? Sort of easy enough to come around to some conclusions on O&M. But what do you do with things like reserves for replacement of inverters? And what is often, frankly, the killer is what are land costs, what are taxes? Residual value, what is the thing worth sort of at the end of a particular contract life? And finally, what's the discount rate or cost of capital that's implicit in the valuation of the asset? So what I want to talk about here today is three of these drivers where I think sort of some interesting things are going on in terms of movement in the market: revenues, residual, and cost of capital. So on the revenue side, there's a couple things that I have seen, as we've been out in the market. We're in the market buying assets in development as well as operating assets. And the thing that I've really, in this respect, on the revenue side, has been noteworthy, I think, over the course of this year is sort of more attention being paid to uncontracted revenues. Sort of the easy thing to do is to say, I've got an investment grade power contract with somebody who's got this price. That's not that hard to value, putting aside your cost of capital issues. What is harder to figure out is what do you do with uncontracted revenues, and that's certainly dependent on, among other things, what regulatory regime is there to support those revenues. And the thing we've seen in particular in the Northeast is a willingness, at least of some investors, to take positions with respect to the value of SRECs. The challenge is that it's expensive, and I'll get to that when I start talking about cost of capital. The other thing is credit of offtake. Again, we play in investment grade, and we also play in non-rated. And in the non-rated, there's like a huge fall off in the amount of capital that's available compared to investment grade or rated offtake. That having been said, there is in fact money out there, and people are able to transact. But the question is sort of what's the uptick in the price to do that? And if a year ago I would have said, the answer was there is no uptick because there is no money. Today I would say, well, actually there is money, but you have to be thinking about 100 to 200 basis point sort of change in the valuation if you're accessing that particular capital. Residual value, what is the thing worth at the end of the term? This issue is really a function of how long can you stay on the property? What is the nature of the project? If it's a DG project with an industrial host with a 20-year contract, a 20-year lease, the residual value is actually probably not a whole lot because it's what is your ability to take that and convert it to more revenue with that particular customer, unless you have the ability to stay there and access the grid and sell to the utility. More interesting is small utility scale, where even if you have a relatively short tenor PPA, you can come to a conclusion there's value to that, assuming you can stay on the property. You got a 30-year lease, let's say, or the property's owned, in terms of what power can be sold for over time. And so the trend that we've seen here is, if a year ago I would have said, gee, the rule of thumb is on a commercial DG deal, the residual is frankly not very large at all, and on a small utility deal, you might clock in maybe like 5 years more revenue at the same rate. And what's been happening is more and more aggressive assumptions being taken with respect to that residual value, so going to longer tenor, going to a longer period of time, and then making some interesting assumptions about what pricing will be, whether it's supported by a power market study or a finger in the air. But I've indicated here, we see, for example, deals that have 15-year contracts, but people will be valuing tails based on 30 years of revenue. And it provides a huge uptick in the value of the asset. We just ran a couple of examples. And a 21 to 27% increase in the NPV as a result of what's done with the residual. Frankly, that's pretty decent, but it's nothing compared to transactions that we've seen where the residual, at least as presented by the seller, would say that the residual is, actually assuming not a flat or declining rate over time, but an escalating one. It can result in effectively like a 50% increase in the value of the project. Cost of capital. Generally on a downward curve. Part of that is it's just a function of investors in the market looking around for yield elsewhere, greater comfort that this stuff actually works, and the return expectation for investment in these assets coming down to match other asset classes. But the other thing that's going on is really the nature of the buyers is changing, or the nature of the investors, and I guess I hit this on the next slide, but really we're in this transition where Folks who used to spend all their time in the utility sector are now enamored of DG. And I don't know if that's because DG is so attractive as opposed to utility just being so freaking ugly at this point. But utilities, larger companies are coming into the space and essentially just able to bring a lower cost of capital. We talked a little bit about yieldcos. You know, today I'd say I don't see that much of an effect on the market from yieldcos in terms of pricing. You can come up with a theoretical cost of capital for a yieldco, but there aren't that many that are active in the space. There's basically one. Potentially these guys will have another one. And you have what I would call incipient yieldcos, people that are out rolling up assets to put into a yieldco when they get to a sufficient mass and may be willing to price up to get the assets to roll in. And finally, another driver is just frankly better debt terms. I mean, I really agree with Mike in terms of the breadth of the market that's out there, and there's a slide I'll show in terms of kind of what we see in terms of the effect of better terms on debt. So I ran a couple of slides, and again, I mean, all this stuff you'd have to take with a huge grain of salt because it really is a function of sort of what you put into these things. But the point here is that as you look and decrease the cost of capital, it just basically results in a not insignificant bump in the NPV of the project. And so if we're talking about differences, between an 8%, and a 7% and a below 7% return, you're starting to see a pretty significant uplift in terms of what can be paid for a project and still have that target return being met. The other way to look at it is, how does cost of capital play in terms of what you can do in PPAs? I think maybe we'll draw some questions about like what happens after the ITC goes up in smoke. Well, part of it's going to be, well, what's the overall cost of capital, if ITC is not extended? And the point here is that you can actually, result in, I mean, you have to read this chart somewhat backwards, but the point is that as all-in costs come down, into that 7 and under 7% range, you start to see that you get down lower and lower, prices on PPAs, and that's just sort of part of the game. So either the world today works that if you have a power contract that's well priced, you're going to get paid more because of that lower cost of capital. If you hang on longer, cost of capital may go lower, depending on what you think is going to happen with interest rates. Maybe you get paid more. But more importantly, as you look forward, the trend that we had over the last few years of a downtrend in power contract prices, which was really led by equipment prices, is actually potentially now being led by capital cost reductions. I wanted to put this slide up because I really, agree with Mike. I mean, the debt market is a wonderful place, but the trick is how do you get, it's not necessarily the cheapest debt, it's more the longest tenor debt, and we spend a lot of time on this. So we typically now, we can do like 23 years of debt. It's not that we provide it, it's that in our structure we can get that. And we kind of run this model to say, well, what is the impact on a project PPA price from basically being able to put more debt in the transaction simply as a result of getting longer tenor and a lower margin. And the effect here again, garbage in, garbage out, is you can effect a fairly significant reduction in what would be a power contract price as a result of doing that. And again, that, if you think about it in the reverse, that permits one with that kind of debt to pay more for an asset that has a known power price. This will be a slide. I mean, if we start talking about post-2017, this to me is part of that universe, which is figuring out how to get longer tenor debt for these transactions is going to be one of the ways the business will continue to succeed. Buyers, in the DG space, I think I already sort of hit this, which is, the world is changing from one where most of the capital is coming from private equity firms and funds or the equivalent to coming out of strategics, or in our case, we're effectively like a fund supported by a strategic. Integrated solar companies, SunEdison's a good example, NRG is another good example. Folks that have access to capital, in particular in the public markets, which are permitting them to potentially bid up prices and bid down yield. And then finally, yieldcos and incipient yieldcos, which I would say it's very easy on the yieldco side to get mesmerized by what's sort of the public dividend rate that's paid. And what you really have to look at is what's the all-in ability to buy and at what price through that vehicle. And there is, in fact, you've got a cost in the middle. But what we've seen is at least bids from sort of entities that are sort of in that space haven't bid down to the rate that they can get to because the market doesn't quite force them to get there. But it still is sort of a pulling down of where pricing is or the cost of capital is in the market. One of the companies that's out there, for example, is it's an incipient yieldco focused on utility assets more than DG. Their proposition is that they'll run a private market valuation of the asset, and for participation in an IPO will guarantee a 15 to 40% uplift from the private valuation price. And that's all effectively what you think the cost of capital is going to be for that public deal. So where's pricing? Actually, I didn't put attribution on here. I actually stole these numbers out of Sol Systems. I thought they were pretty helpful. I think they were consistent with our experience. And in a way, I would have to say they are relevant. I mean, they're relevant. They're based on data. They're also, like a lot of price comparisons, hugely unuseful in looking at a particular asset because the spread is so wide. The takeaway from the price range is the smaller you go, the less you get paid, or the higher cost, and the larger you go, right? The price can be all over the place. So what we've seen, and be interested to hear what other buyers of assets are seeing, is that pricing around these assets, while you can come to sort of some common agreement around how the systems are going to operate, the assets vary widely in terms of where they're located based on, it's not just, it's production, but it's also what are the costs associated with tax, property value, property costs, and the like. Where people are at in terms of bids, in terms of their residual assumptions, where they're at in terms of goosing production numbers, based on their own view of how well they can operate the asset. And so a lot of discussion occurs around sort of the cost of capital impact, and sort of that is the thing that really makes a difference. But actually, that's just one piece of many that results in, from what we've seen, bid spreads. I mean, when you look at bids that come in for assets, there's really a very wide divergence. And I put down here 2 to 1. I mean, that was just literally like a deal I just pulled up and looked at. I've seen spreads as much as 4 to 1, okay, top to bottom in terms of premium over cost of install, based on basically, presumably, people having different assumptions about how the project will operate, what it's going to be worth at the end of a contracted term, what they do with uncontracted revenues, how they view their own cost of capital, et cetera. So it's still a really inefficient market, and there's all kinds of data you can look at, but the reality is you got to look at sort of each deal and really kind of try to figure out, if you're a seller, what are the things that drive a buyer, and not every buyer is the same in terms of what they're going to value in that particular asset. So that's my 15 minutes, actually over by 16 seconds, my contact information. Look forward to Q&A.
I would actually start by saying that we as an industry should not plan for it stepping down. We should be pushing as hard as we can to potentially extend it, and I'm sure our friends at SEIA are working night and day on that exact topic. I think the solar industry has been massively out-lobbied by more traditional fuel sources that have done a great job at keeping their subsidies for much longer. So I would say, if it's any precedent, there should be a decent chance of keeping it at 30. But you obviously want to have a plan B if it does step down. If it does step down, I think, the silver lining in many ways is that for parts of the market that have struggled to kind of procure tax equity, or where the projects have been too small to kind of line it up at all, it becomes less relevant. Projects everywhere else on the planet outside of the U.S. don't bother with tax equity. Essentially, they still have depreciation, but what ends up happening is that the project itself generates cash flows in excess of the costs. It generates profits, therefore, that are taxable, and it just has a carry forward of that depreciation. It doesn't use it all at once, but it still is acceptable. So hypothetically, if we have the ITC step down to 10%, maybe it just gets used directly by the project without having to involve third parties to provide pure tax equity. So that could be a silver lining. I do think, though, that there's a real chance that you have a bunch of projects where they get started by 2016, and so they still qualify for the 30%. So this is maybe more of a 2018 kind of issue.
And Mike, how does that affect debt? You know, if there's less tax equity involved, does that all that capital requirements just shift to debt, or you know, what might we see also in terms of interest rates and tenors as well?
I think it does shift to debt. It will shift to debt, again, assuming that if it were to step down, it's going to shift to debt in a very large way. And that can be, you know, while that's cheaper financing, we still have the liquidity issue that we have to address. If we need to replace large amounts of tax equity in the market with debt in 2017, will we have enough liquidity in the markets, enough players, enough cash, enough investors that want to invest in projects to fill that void? So that's one thing to be thoughtful of. And another thing to be mindful of also is, you know, are we going to have enough projects that will be financeable or that will pencil out at that time? So, because it's going to change the dynamics, you're going to have less in the capital stack, potentially less in the capital stack. You may have more opportunity for subordinated debt on transactions, but that money is very limited. You know, I had it in my presentation, but it is very limited. It's just not that deep in the market yet. I will say also the one other thing to think about is that I think even if tax equity does step down, I think Brett is correct that you might see in some markets, so some states, you might see the structures being simplified. In other markets and with individual project opportunities, it might still make sense to have tax equity on the transaction if you can get the tax equity players to play for the depreciation of makers, et cetera. But the structures might be a lot simpler than what we're facing now, and transaction costs would go down. I think that what's going to drive that point is really irradiation locations and also state incentives. So when you have markets like Hawaii, California, and potentially New York, those markets, I just suggest, it might be easier just to do with debt because of the high incentives. Other places, it might make it might be more interesting to have tax equity in. I just suggest that the landscape across the United States might become more pronounced and acute for financial decisions on projects.
And just to follow up real quickly, you know, in terms of the liquidity issue with that, do you think the absence of tax equity will help liquidity at all? Are debt investors right now scared by the tax equity piece in the project?
I think tax equity is scared of the debt piece in the project. So actually, it's a great question, but I don't really see that. I don't see debt on the sidelines because there's tax equity in the transaction. I don't see that decision in financial institutions. It's a great question, though.
Sure. And then Ed, finishing up with you, certainly there's an effect on cost of capital that you're talking about, and but beyond just that, you know, are there any other things that will shift in terms of project valuation as more of the capital is provided by debt versus tax equity?
Well, I think a big difference is going to be the view of the assets or the life of the asset. You know, one of the, Darren, leave the room. I don't want to insult anybody here. The thing that kind of has surprised me, but I guess I should have known, was when we've gone out to look for capital, what we have is basically a large corporation saying we'll guarantee performance of the system for 20 years. And so people like life companies, pension funds that aren't solar jocks, but want to invest in the space really like that, because they're like, hey, we want to hold this asset for 25 years. We think it's really cool that somebody that actually has a balance sheet is going to stand behind us. The response from the tax equity market was like, hey, I'm out in 5. Mm-hmm. So, you know, there's a little bit of a tendency, because of the business being so heavily driven by tax equity, to maybe not sort of look at those out years. So I think what'll happen, and this is part of what really helps drive yield co's, it's when we talk about securitization or any kind of longer tenor debt out of public markets, whatever sort of shape that has. I think that you'll see, and I kind of alluded to it in my presentation, where if you can think about these assets of having, a life of 35 years, even if it's not contracted for that period of time, you can come to a decision about the value of that in those out years. And then it's a question of, can you persuade debt to go long? I mean, I would say, as Mike pointed out, for the institutional lenders now, they won't go beyond contract terms, but the interesting question would be, well, in a public vehicle, would people basically be willing to finance those out years? And certainly on the equity side, if you think about the yieldco model, that is, I mean, a big uplift comes from the ability to say, hey, it's 35-year asset, I'll give you, value for those out years. That, to me, is a pretty significant shift in mindset about sort of the business as a whole. In terms of what happens with tax equity, there's not, I mean, what's going to happen is, whatever happens, it'll be disruptive, right? Because it's almost impossible to make a clean break from sort of where we are today to where we will be at a future date. And probably the most likely outcome is there'll be a muddle in the middle where maybe we'll do, with the ITC, the same thing that was done with the PTC with, oh no, it's not in service, it's when you start construction, so we'll diddle each other, around on that one for a couple years. But at the end of the day, it seems like the tax credits are probably going to phase out, and then you just need to focus on, okay, how much cash do these things actually produce? And if you do the math, you kind of realize that there's other things that have to give for these to work. Balance of system has to come down, cost of capital has to come down, equipment prices have to continue to come down in order to remain competitive, as a service being offered to people to displace, what they can get off the grid.
Definitely makes sense. And I like the point about being solar jocks and not solar nerds. Actually.
Hey, I'm trying to dress it up as best I can.
Well, let's take, we have, a few minutes left. Let's open it up to the audience. Does anyone out there have a question for one of our panelists? All right, if not, I want to just follow up with, each of you talked a little bit about, non-traditional players or new players in the market getting involved in solar, looking at solar as a more feasible investment asset. It's certainly been talked a lot in tax equity, Brett, and you had a slide that showed some people that are notably absent, and I'm wondering if you can maybe address, how do we get them into the game? How do we get them to actually invest in solar? What's missing?
I mean, I don't actually have a great answer for that question. I think there might be, some folks in this room who are actively knocking on those doors, trying to get those same players to invest, to become, potential owners or tax equity investors at the very least. I think, part of it is just the size, right? So I think for a while, if you're a large company and you wanted to shield, profits, there were other methods of basically providing tax equity, through low-income housing or other more sort of established industries that were either larger or more familiar to sort of the kind of finance functions of these large firms. And so I think they would look at solar and say, well, it's too small, or we're not sure that we want to get up to speed on all the nuances there. But I think solar is getting big enough now that for those same firms, they need to pay attention to it. And I think one of the great things having, some of these marquee firms like a Google step in is that it does, have kind of a peer pressure element to it, which is, well, if Google's doing it, like what's going on with, the other names in the space? Like what about Facebook? What about Yahoo? What about, well, the ones that are profitable, for example, they need to start thinking. So I think there could be a little bit of like a cumulative effect or a tipping point where you get a number of these firms that were on the sidelines, they finally start to step in, and you get a rush of new entrants. So that's a possibility.
Sure.
Can I jump in there? Because
Absolutely.
There's been such a huge effort made to get new tax equity investors in the space, and it's, it's a challenging market, right? Because if you just think about that as a product, it really works well for financial institutions, but if you're, a treasurer in a corporation looking for an investment, to have sort of a okay yielding investment that's illiquid, compared to everything else that's on your plate, it's a tough sell. What's more interesting, I think, about firms like a Google or Facebook or give me a name is it's not for them. It's not I want to be a passive investor in some guy's solar facility someplace. It's hey, this is actually I should be thinking about this business much more broadly, and it's not just sort of for my own use, but actually it's a customer access issue. So I think that's where you probably will see them play more, which is not to be your investor, but your competitor.
Interesting. So I'm curious, if we'll just jump over Mike for a second, Ed, and talking about some of the maybe new investors, new people buying the projects. Do you see new types of players that are looking to actually own and operate these systems over the long term? Some non-traditional people that we might not think of.
Well, that's an interesting question. I mean, I think that what's going on now is utilities getting serious about the space, not just as investors, but as basically people who are going to be providing a service, whether it's directly or indirectly through a sub. I think we're seeing the same thing with technology companies doing. I mean, that's effectively what we're doing. And the question is, are there? I mean, there's so many other for the DG business in particular, for C&I and a whole different game in residential, is there are so many entities that have an access to and are interested in an interface with a customer for a variety of services that they can offer. It's almost like who isn't a competitor, who isn't today already providing some kind of service to a guy with a plant or a person with a house or whatever the ultimate customer is. Utility business, totally different. But this stuff, it's got a long ways to go to play itself out. And I have a hard time figuring out, okay, well, in a decade, the companies we'll think of as being big DG companies are fill in the blank. I mean, I could probably come up with 20 names from very different businesses.
Okay. And then wrapping up, Mike, on the debt side, you mentioned that insurance companies, they've dabbled a little bit but haven't been super involved. What's been the barrier there? And then in terms of just other new sort of financial players that could fill gaps that you see currently in the debt markets?
It's a great question. I think to provide the liquidity that's needed in the DG debt market, especially if we have a step down of the ITC, I think the insurance companies will play a great role in residential financing, because I think we're developing in the industry, we're looking at and developing securities that are very liquid, both for the primary market. Primary market means when you initially buy. Secondary market, when you can resell it because you think it's going to tank, or you believe you can make a market on it. So when we see the secondary market develop for securities, whether it be green bonds or even private placements, that can be resold. I think that you'll see an acceleration of interest from insurance companies, and I think it'll play out. You'll see it first, certainly in residential, and anything that can be aggregated, whatever your vehicle is. So I think that's one area. The other area is commercial banks, and large commercial banks and the international commercial banks. They have a lack of deal flow right now because of the wane of the financing for central station financing, the large utility scale financings that occurred. And they are looking at this space, and they are looking at how to play in this space. And what you are seeing is that companies like Deutsche Bank and Bank of America are developing construction loan liquidity facilities for some of the large players, some of the large technology providers, the module manufacturers, and also IPPs in the business. So we're starting to see some move over from these players, and they'll provide a lot more liquidity in the market. And I agree with Ed. There's going to be business models and companies that emerge that are going to play in this space that just aren't on the radar yet, too. So it's kind of interesting and very exciting.
All right, great, thank you. And that really is all the time that we have, unfortunately. I encourage everyone to tap into these guys' expertise. They have a lot of them. Right now, I'd like to welcome the next group of speakers up to the stage. And in the meantime, let's give these guys a round of
Nicely done.
Round of
Brett,
applause.
nicely done.